McDonald's is not in the burger business. It controls more commercial real estate than many property investment trusts, collects rent from nearly every location that carries its name, and earns higher margins from property than from food. More than 95% of its restaurants are franchised. Corporate operating margins often exceed 40%. The franchisees who cook the foods typically operate on single-digit margins. That tension defines the model. The brand looks like a fast food chain. The economics resemble a landlord. The public story centers on scale. McDonald's sells billions of burgers and fries across more than 40,000 restaurants worldwide. Scale drives efficiency. Efficiency drives profit. But the corporation does not primarily make money selling food. It makes money selling access to its system and leasing access to its land. When a franchisee opens a McDonald's, the corporation usually controls the real estate. In many cases, it owns the land and building. In others, it signs a long-term master lease and subleases the site to the franchisee. The franchisee funds equipment, hires employees, buys inventory, and manages daily operations. In exchange for the brand and operating system, the franchisee pays a royalty based on revenue and pays rent. The rent is the anchor. Because McDonald's controls the site, it captures predictable income regardless of the franchisee's cost structure. Royalties align incentives around revenue growth. Rent protects the downside. If wages rise or food costs spike, the franchisee absorbs the pressure. The corporation still collects rent and royalties as long as sales continue. Operational volatility becomes contractual income. The turning point came early. In the 1950s, Ray Kroc scaled the system after partnering with the McDonald brothers, but executive Harry Sunborn reframed the business. He argued that McDonald's should view itself as a real estate company that collects rent from franchisees who happen to sell hamburgers. That insight shaped capital allocation. Instead of only licensing the brand, the corporation began acquiring prime intersections. It targeted high-traffic corners, negotiated favorable terms, and developed standardized buildings. Franchisees were selected not just for operational skill, but for their ability to meet rent obligations. Location determined both sales volume and property value. Over time, the balance sheet filled with land and buildings. Today, McDonald's controls tens of billions of dollars in property and equipment, much of it owned real estate. Even where it leases, it often secures long-term agreements at fixed rates and subleases at higher effective rents, capturing the spread. Rent behaves differently than burger sales. Restaurant operations are cyclical. They are exposed to commodity prices, wage inflation, competition, and shifting demand. Prime commercial real estate is constrained by zoning and geography. There are only so many high-traffic corners in any city. Control those sites and you control access to demand. By anchoring the model in property, McDonald's converted variable restaurant earnings into royalty income and real estate yield. The result is stable cash flow for a company perceived as part of a volatile industry. The financial statements make this visible. Company-operated restaurants generate higher reported revenue because they include food sales, but they carry lower margins because the corporation bears operating costs. Franchise restaurants contribute less reported revenue at the corporate level, since only royalties and rent are recorded. Yet those streams are high margin. That mix drives the elevated corporate margin. The structure becomes clearest during stress. When minimum wages rise, franchisees feel it immediately. When beef prices rise, their costs increase. When a local market weakens, sales decline. The corporation's exposure is buffered. Rent is often structured as a percentage of sales with minimum thresholds. Royalties are tied to top-line revenue, not net profit. As long as sales remain sufficient, the corporate entity is insulated from kitchen-level cost pressures. The corporation is not indifferent to franchisee health. If franchisees fail, locations close and rent stops. But the risk profile is asymmetric. The franchisee's capital is tied up in equipment and operations. The corporation's capital is tied up in land. Land in prime corridors rarely loses relevance quickly. This explains the emphasis on standardization. The menu, kitchen layout, and marketing are tightly controlled, not only to protect the brand, but to protect property yield. Standardization reduces execution risk. Lower risk supports stable sales. Stable sales support rent coverage. The brand generates demand. The real estate secures the return. The pattern repeats internationally. Local franchise partners often fund expansion, while the corporation retains control over branding and site strategy. As cities grow and commercial corridors mature, the real estate component compounds in value. Even where it does not own every parcel, its control over site approval embeds it in the land economics. The burger is the transaction. The intersection is the asset. Because rent is tied to revenue, the corporation is motivated to drive system-wide sales through advertising and product innovation. Because it controls the land, it is motivated to protect long-term site quality. Franchisees who bear operating volatility focus on cost discipline. Risk is distributed to those best positioned to manage it. The model also creates constraints. A pure restaurant operator might shrink quickly during downturns or pivot formats aggressively. A property-anchored system favors durability. Long-term leases and owned land encourage incremental adaptation. Experiments with new formats or delivery occur within a portfolio designed around drive-thru traffic and established corridors. Past capital allocation narrows future flexibility. Valuation reflects this structure. Compare McDonald's to a typical restaurant chain and the multiples can appear elevated. Compare it to a global franchisor with a large real estate portfolio and contractual cash flows, and the framework changes. Investors are pricing royalties and rent backed by prime commercial land. The broader lesson extends beyond this company. Many firms that appear to sell products are built on control of a scarce input. Sometimes that input is land. Sometimes it is spectrum, intellectual property, or platform access. Control the bottleneck and you control the margin. In this case, the rent is literal. Customers pay for meals. Franchisees pay for brand access and site access. The corporation collects royalties and rent. Value compounds through same-store sales growth and through decades of accumulated property in high-traffic locations. That portfolio is difficult to replicate. Competitors can copy menu items. They cannot easily assemble thousands of prime intersections under long-term control. Zoning constraints and traffic patterns create natural limits. Early acquisition created a durable moat. The opening contradiction is economic. If McDonald's were primarily a restaurant operator, its margins would resemble those of its franchisees. Earnings would fluctuate more sharply with labor markets and food inflation. The balance sheet would be lighter. Instead, it holds substantial property assets and earns a significant share of income from rent and royalties. The golden arches mark not just a kitchen, but controlled commercial terrain. That perspective reframes its strategy. Store renovations protect asset value. Digital ordering and drive-thru efficiency protect revenue that underwrites rent coverage. Entering a new market means selecting sites that can anchor cash flow for decades. The food is visible. The lease is foundational. McDonald's sells hamburgers, but its empire is built on corners, contracts, and the long-term control of land. That is a different business than it first appeared.